From the University of Westminster, this is The Week Ahead with Dave Coker.
All right, guys, welcome. This is The Week Ahead. It's Sunday, October 11th, 2020. Let's talk about what might happen next week in the markets and the impact. So key events coming up. Remember, we always try to summarize 5 key events here on this slide. Oh, my animation. Oh, my God. So an IMF meeting. It's a virtual meeting. Still, we'll get the good news out of it, or the good quantity of news. And pay attention to it, because the IMF has some pretty strong opinions about how we can solve this corona crash, the corona crisis. And basically what it means is taxes. So pay attention to what they're saying. In an election year in the States, we think there'll be a lot of attention brought to bear upon, especially what the IMF says if they're into profligacy and spending money. The stimulus talks in the States have stalled. This is, of course, an election year. The election's about 25 days away. Pay attention to what happens with these talks. Both sides are eager to do a deal, because it's not only the president who's standing for election, but other representatives that are being chosen. They need something to show people. And right now, if you're in America, as I always tell students, if you want to get rich really fast, the States is a good place to go, because the entire system is skewed towards the accumulation of wealth. Social benefits, not in America. So if you've lost your job because of the corona crash in the States, if you don't have adequate savings, you are in a world of pain. So we'll have to see what happens with the stimulus talks. We've got some good data coming out. I put it in the notes for CPI, Consumer Price Index, and unemployment. Corporate earnings really takes the stage, starting this week with banks. So we'll get a good draw on what happened in Q3, and we'll see what we're setting up for Q4 as well. And Brexit, I think the deadline is Thursday. So pay attention to what happens there. Again, this could make or break the entire Brexit deal, set the stage for developments going forward in the UK. All right, we're going to look at the S&P 500 over the past week. You can see it's been a good week. We're starting to get some clarity, or at least the markets believe that there's some clarity coming in with respect to the US election. And it does look like Mr. Biden's going to take it. Markets hate uncertainty. So even though some market participants may have preferred Mr. Trump over Mr. Biden, in actuality, guys, what the market really wants is to see clarity. And so this works out really, really well, this idea that we know exactly what's going to be happening overall for the next 4 years. At least we got a known entity in the White House, and we can start to price things out. So some fairly good gains over the past week. Can they continue? One thing, and again, we're going to go through all these valuation ratios by the time we finish the term. This is called price to sales. So essentially what we're looking at is the ratio of a share price to the amount of sales that is done per share. And you can see, guys, again, the standard color coding applies. Red means it's sort of in a dangerous territory. Green means it's good, it's in a good territory. Neutral point would be a quotient of 1, which means investors are paying $1 for $1 worth of earnings going forward. These other ratios like Microsoft 11.14, Apple 7.18, Amazon, that means investors are overpaying for $1 of earnings now. And essentially the reason they're doing that is they think these high growth companies, the share price will pick up over the horizon and basically shield them from many problems. Here's another one, guys. Dividends are very important. And as I've shared with you guys before, I invest only for dividends. So I love to point out things like this. This is from a Twitter account that I follow, Dividend Growth Investor. You can follow them as well. They're on FinTwit. So if you sign up for FinTwit, you'll get about 30, 40 of these pretty high signal to noise ratios. Now, he's talking about investing $1 in Philip Morris, currently called Altria, used to be called Philip Morris. If you put $1 into Philip Morris in 1920 and religiously reinvested all the dividends into additional shares, that $1 would be worth 8.4 million now. So again, it's a long horizon, but it shows you the importance of being in it for the long term, guys. And this is one thing that I reiterate. You're not going to be a trader. Don't think about this, that you're going to get the degree from Westminster, come out and trade and use your own money and make millions. It's unlikely. It has a non-zero probability of taking place, of course, but in general, I doubt it's going to happen. No disrespect to anyone. The way you're going to build wealth is by investing only for dividends and doing what I did and what is illustrated here, just reinvesting the dividends over time. So you get the dividends, you don't spend it, you don't party with it, you reinvest the dividends in additional shares of your cash flow generating assets. Here's an interesting one. Mr. Biden has a policy proposal. He wants to change the long-term capital gains rate. It's currently 23.8, have to go up to 39.6. It's a steep increase. And what that's going to mean is there's going to be some stock market vulnerability in the near term because investors will have to get a much, much higher return to justify paying these much, much higher taxes. All right, let's dive into the day-by-day stuff, right? Oh boy, there we go again. Yeah, there wasn't much going on Monday, so I just picked up these 2 points. We got 3 and 6 month T-bill auctions. Previous was 9.5 basis points and 11 basis points respectively. Now, what I thought I would do is show you over the past 5 years, show you exactly what's going on with short-term rates. And you can see, guys, at the short end of the yield curve, we started to pick up. We were almost normalized back in 2015 April or 2019 April, and then we started to see it trending down again. There's a little bit of uncertainty and risk there. People were concerned about the economic cycle. People were concerned about the stock market. And then, of course, in April of this year, we had the Corona crash, and look what happened to those rates. My God, essentially down to zero for all intents and purposes. Not that they're much higher now, but they did spike back up, and now they're trading sideways. All right, on Tuesday, October 13th, we got CPI, Consumer Price Index, both year on year and month on month for September. So you can see how anemic inflation is allegedly in the States. The prior CPI year on year was 1.4. We're forecast to see a 1.3. So that means inflation over the prior year really running about 1.3% according to this metric, which I don't necessarily believe in. But we'll talk about that later. And then month-on-month figure, the prior was 0.4% or 40 basis points. Forecast to come in at 20 basis points. So that's for September. So the August or September time period. Real earnings. How much did people's paychecks go up after inflation, if they were fortunate enough to be working? Prior was a 0.3% increase. Forecast, we don't have anything. Admin didn't get us anything, but pay attention to that because once again, as earnings go up, people become more confident about spending money. As people are more confident about spending money, consumption goes up. As consumption goes up, it has a positive impact on GDP, on gross domestic product. And also share prices typically go up because they're doing more business. They're capturing more revenue. They're making more profits. So that's why we pay attention to this. At 1 o'clock, we got the federal budget balance. Prior was a $200 billion shortfall. They're correcting it a little bit. Yeah, now it's forecast to come in at $124 billion. Still, these are huge deficits that they're running. Is totally unparalleled in peacetime. Of course, during war, the United States has run similar budget deficits, but in peacetime, it's absolutely ridiculous, the amount of money. Wednesday, October 14th, some choice things for you to look at. And I say choice because there's about 40 factors. I'm really don't know what I'm going to be looking at that day. There's a lot of news coming out on Wednesday, but important ones for you. And remember, we do this so we help you develop your own sense of market awareness, looking at your own indices, your own figures. These are what I look at. And as I said, Wednesday is a very big data heavy day. Starting off at 0830 hours, continuing jobless claims. Now watch this. Prior was 10,976K. Forecast 11,400K. Yes, that's unfortunately that translates into million. So people that are still unemployed, still drawing unemployment benefits, which is a real shaky game in the States because you're not getting them for the rest of your life if you're laid off for the rest of your life. It's not like Europe where you just sign up and you collect. So these people, unfortunately, it depends upon the state. But it's conceivable, and after 12 months of being on unemployment, they're off unemployment. They no longer counted, but they're not working. So we see that there's an unprecedented number of people unemployed in the States. These are continuing claims, the people that are still staying on unemployment. At 0830 hours, we got jobless claims, the initial jobless claims, I should say. Prior 840,000, forecast to come in at 830. Slight improvement, but nothing like it was before the Corona crash. PPI, we got two flavors. Producer Price Index. This is the other side of CPI. CPI is what you pay. PPI is what the producers of a good or service pay. We have year-on-year, month-on-month, both for September. Watch the PPI year-on-year numbers. My God. Prior was a 0.2% fall. Forecast to come up at 0.2% increase. Yeah, I don't know. We'll have to see what happens there. Nobody really knows. But pay attention because, again, big miss, big difference could move the markets. And that's why we look at this stuff. PPI month-on-month in September, 0.3% increase. Prior forecast, little weakening coming in at 0.2%. And at 1400 hours, the big one, the beige book. Now, guys, this is where we have 12 Federal Reserve regional banks. And what happens is the Fed in Washington can't keep track of what's going on in all these different locations in Georgia, in Miami, in New York, in Seattle. They have no way of knowing exactly in great detail what's going on in Los Angeles. So there's 12 Federal Reserve regional banks. They report in periodically every 6 weeks to the Federal Reserve in Washington about economic conditions in their region. So, of course, we pay attention to what they're up to. We pay attention to the beige book because this gives us an idea of the policy decisions the Fed is going to make in the next meeting. And again, when you develop a sense for this, when you watch this stuff enough, guys, you are never surprised. And I'm rarely surprised by what the Fed gets up to because I tend to watch what they're doing with great detail. On Thursday, oh, my animation's messed up again. On Thursday, there we go. Look at that animation. Horrible. Thursday, October 15th. At 0830 hours, we have two important numbers. Well, three important numbers coming out. Two are very important, and one is pretty important. They're all important. Here we go. Initial jobless claims week on week. I made a mistake there. My God, I've got okay, I'm so sorry about this. Initial jobless claims week on week. Prior was 837,000 jobs. Forecast to come in at 823,000. I am so sorry about this, guys. I duplicated this slide. This thing. So there's jobless claims coming in. The first one's correct. Jobless claims, the 4-week average, it's forecast to come in, or the prior was 867,000.25. In other words, 867,250 people unemployed. We don't have a forecast on it. We've also got 4- and 8-week T-bill auctions coming in at 1,100 hours. Prior was 9 basis points, forecast to come in at 9 basis points. So interest rates are pretty low. Friday, October 16th, we have retail sales coming in month on month for September. Prior was 0.6%, forecast to come in at 0.6%. No big difference there, but watch. It'll show you how people are spending money. I wouldn't be surprised to see a fall in retail sales because we know people are being cut off from benefits in the States. And once again, if they ain't got no money to pay the rent, ain't got no money to pay to buy food, in general, retail sales are going to fall. They're just not going to be spending money. At 9:15, we have capacity utilization rate. What we're doing here is we're looking at manufacturing capacity in the United States, trying to see how much we're using. It's never 100. I think I've seen it top out at about 94, 95%. But here you see there's been a big sharp drop. Prior, we were using 71.4% of our manufacturing capacity. Forecast to come in at 71.9, tied in, of course, to retail sales and consumption overall. Industrial production, year on year for September, and we have month on month for September as well coming in at 9:15. Prior was, for the year on year data, prior was a 7.73% contraction in industrial production. Forecast, admin didn't get us a forecast, I'm not sure what that is. 9:15, we have industrial production month on month for September. Prior was 0.4%, forecast to come in at 0.6%. A modest increase in industrial production. Okay, guys, that's it for the week ahead. Once again, it's October 11th. Have a profitable week. Go out and make some money. It's there. It's just waiting for you to grab it. There's no sense being poor, guys. Get in the markets. Do it now.